all the factors to drive the gold price and for other reasons the silver price higher are still in place. Nothing's gone away. But one thing they used to say in Wall Street is you never fight the tape. And the tape is going down. In the long run, I'm very confident that we'll go a lot higher. So gold is around just a tad over $4,000 as we speak. I would much rather be a buyer of gold at 4,400 than at 4,000. Now that may be hard to understand, but when it's at 4,400, you've got a feeling that it's now moving in the right direction. And I don't want it to go to 4,400 tomorrow. I want it to gradually grind up there until I say, gosh, I'm missing out on this. I got to get in.
One of the most interesting findings from Thompson's analysis is that a portfolio made up of 60% stocks, 30% gold, and 10% long-term bonds would have delivered better results than the traditional 60-40 strategy across many key performance measures. In his view, gold is much more than a safe haven asset. It can play an important role in improving overall portfolio stability while helping investors navigate periods of uncertainty. But Thompson's outlook goes far beyond investment strategy. He believes the growing debt burden in the United States could eventually push policymakers toward more unconventional solutions. One possibility he discusses is a major revaluation of America's gold reserves. Under this scenario, the U.S. government could dramatically increase the official value of its gold holdings to create additional financial flexibility and address mounting fiscal challenges. Now we present the clips from the interview.
Now, what they could do to solve that problem temporarily, and this could be a permanent problem solving, what they can do is revalue gold that the Treasury holds. The Treasury is the government. The US government holds a lot of gold. They could revalue it to the market value or a much higher value. And I think the argument is strong that they should do it to a much higher value. I picked a bit of a number out of the air and said $15,000 would be a good number. The reason I chose $15,000 it's the number which will allow them to repay a little bit of debt which is maturing and fund the current year's expenditure. In other words, we can end the year next year with less debt and with having paid all the expenses. But let's just explain how they would do that and how it works. The mechanism is very straightforward and it's a well-trodden route, so it can be done before. It's been done before in 1934 in a slightly different way, but more or less the same thing. The first step would be for the Treasury to sell its gold to the Federal Reserve at whatever price they declare is the new floor for gold. Let's say $15,000 an ounce. The Federal Reserve pays the Treasury for the gold at the market price, which is now $15,000 an ounce, let's say. That gives the government enough money to pay all the debt, all the expenditure this year and next year, and to reduce, or rather redeem, bonds which are maturing without having to take out new debt. The Federal Reserve has now got the gold, the Treasury's got the money. The next thing the Treasury does is to buy back that gold from the Federal Reserve using what's called gold notes. Now, gold notes are not new. The Federal Reserve has already got a whole bunch of gold notes from the last time they went through this exercise. Last time the Treasury bought the gold off the Federal Reserve, they gave them gold notes. But the beauty of gold notes is this. They're not part of the national debt. They don't bear any interest, and they are perpetual. So if I borrow some money from you and I give you a bit of paper saying I borrowed the money from you, but it's not part, I don't owe anybody anything because it's not part of my debt. So I'm feeling good. And by the way, I don't have to pay you any interest. And by the way, I don't ever have to repay you. I'm sitting pretty. So that's what the government should do. Now, the Federal Reserve is and can, and always has treated these gold notes that it owns as money, as an asset. So you've got two sides of the coin. Even though it's technically a liability of the government, it's not part of the national debt, and since it's never repayable, it's only redeemable if the government decides to redeem it. Basically, it's like a banknote; it's a worthless bit of paper. It's irredeemable with no interest, and the government's got the money's when they've completed this exercise, the government's got its gold back in full. It's got the money. The Federal Reserve is still happy because it's got an asset, the gold notes, so its books balance, And we've got a whole bunch of money now sitting in the Treasury, which can be used to redeem the maturing debt as it comes up and to pay the ongoing expenses without having to borrow money for a year or so. Over virtually any period, i.e. any starting date until today, having some gold in your portfolio would have improved its return. It would have improved its Sharpe ratio compared with the traditional 60-40 portfolio. And it would have reduced the biggest loss. That's a peak to trough cycle. It would have reduced the biggest loss from whatever it was to a smaller loss if you had gold. Now, the optimal amount of gold does somewhat vary according to your starting date. But what I can say is, had you put in around 30% of gold at any time in history, it would have improved your portfolio compared with a 60-40. So 60-40 would be 60% equities, 40 bonds. If instead you'd had 60 equities, 30 gold, and 10 long-term bonds, you would have done better on all the metrics. Now, it doesn't mean to say that every single date in history, 60, 30, 10, was better than some other ratio. But what it does mean is having some gold. So, for example, in the last 5 or 10 years, the best ratio would have been more like, I can tell you, I've got it in front of me here. If you'd started now, if you started in June 21, that's 5 years ago, your best ratio would have been 35 equities and 64 or 65 gold. If you go back 10 years before that, it would have been 65 equities and 35% gold, zero, in both cases, zero bonds. But as I go back in time, let's say to 1991, the correct ratio would have been 48 equities, 23 bonds, and 28 gold. But overall, 30% gold would have been the perfect number if you couldn't choose your starting date. In the long run, I'm very confident that we'll go a lot higher. All the factors to drive the gold price and for other reasons the silver price higher are still in place. Nothing's gone away. But one thing they used to say in Wall Street is you never fight the tape. And the tape is going down. So gold is around just a tad over $4,000 as we speak. I would much rather be a buyer of gold at 4,400 than at 4,000. Now that may be hard to understand, but when it's at 4,400, you've got a feeling that it's now moving in the right direction. And I don't want it to go to 4,400 tomorrow. I want it to gradually grind up there until I say, gosh, I'm missing out on this. I got to get in.
Many investors have focused on rising bond yields and tighter monetary policy as reasons to stay away from precious metals. Historically, higher interest rates tend to reduce the appeal of assets like gold and silver that do not generate income. But Thompson argues that looking only at interest rates misses a much larger story unfolding beneath the surface. In his view, the silver market is facing a growing supply shortage at a time when industrial demand continues to rise, driven by sectors such as renewable energy, electronics, and advanced manufacturing. Rather than attempting to predict short-term price swings, Thompson advocates a patient approach, gradually accumulating silver over time while market sentiment remains weak. He believes that persistent supply deficits, combined with increasing industrial consumption, could eventually create the conditions for significantly higher prices. While volatility may continue in the months ahead, Thompson sees today's uncertainty as a potential opportunity for long-term investors willing to focus on fundamentals rather than headlines. If you find value in this content, please take a moment to like the video, subscribe to the channel, and turn on post notifications for more videos like this.
I mean, that would be wonderful. We could put everything in at the bottom. But to be honest with you, I know of nobody who ever bought anything at the bottom or of anybody who sold everything at the top. The way to play the game is you put some in and you put some in. So if you buy some at 50 and then at 45 and then at 40, then at 45, then at 50, then at 60, then at 70, then at 80, yes, you might be quite annoyed that you didn't buy the whole lot at 40, and you'd be a little bit annoyed that you paid for some at 60 when it's now 80 and you could have paid 40, but at least you've got in at reasonable prices compared with where it will probably be. And I don't think that the all-time high we saw of 125 is where it's going to stop. There are plenty of people out there who think they know what they're saying, who are printing prices higher than the all-time high even this year. I'm hoping they're right. But what I can say is this: we're in a silver shortage. That's confirmed by the Silver Institute, where they're forecasting a bigger deficit in 2026 than there was in 2025. That deficit has to come from somewhere, and the only way it can come from somewhere is from sellers. Well, both are clearly in bear market territory now. They're down more than 20% from their peaks, and in fact, silver's down 50% and something from its peak. So the peak was $125. It's now, let's call it $62, $63. I mean, maybe it'll be $1 different when you publish this video. The thing which is causing the price, or which everybody says is causing the price fall, has been the prospect of higher interest rates due to higher inflation, and the higher inflation is caused by the war. So, traditionally we look at political crisis as potentially being good for precious metals, although in my career I haven't really seen any strong evidence of that. It's that we're not back in 1945 where people had to fill their pockets with gold and cross the border. But despite the political tensions, they are causing the higher oil price, and the higher oil price will feed through to higher inflation. And that basically means the world is now expecting interest rates to rise. We've got a dead certainty of rises in Europe, the UK, and almost certainly in the United States later this year, probably in December. So higher interest rates, at least the nominal higher interest rates, make people think, I don't want to hold gold, I don't want to hold silver because there's a carry cost, I'm earning nothing. I might as well go into short-term deposits and earn some money. The other side of the coin, I think, is that people have been, up until maybe a week ago, although that's not turned around in direction, but people have been taking money out of gold and silver to put into the fastest moving assets. And the fastest moving assets have been everything to do with data centers, silicon, AI, all that sort of thing. So we've seen almost daily for the last few weeks, last month or so, almost daily, there's 2 or 3 stocks which got 10 or 20% on the back of some story. So a lot of people have been chasing that, saying, well, okay, I missed the last one. It's hurting. Gosh, I meant to buy this, or I meant to buy that. Now it's gone up 20%. So they're kind of running a little bit, trying to find the next one. And I think the money's been coming out of gold and silver miners and gold miners, going into the AI sector. Now, of course, that sector is, as we speak, looking like it's slowing down. It's up today, but it had a very bad day yesterday. So money looks like it's coming out of the bag a little bit. I could perhaps talk about that in a minute or two as to why I think we might have seen the best of it.
Clive Thompson explains that adding gold to a traditional portfolio would have improved performance over almost any time period. In his view, portfolios with some gold didn't just earn better returns, they also handled risk better and suffered smaller losses during major market downturns. This is why he believes the classic 60-40 portfolio stocks and bonds is missing an important piece. He argues that while the exact best mix changes depending on the time period, a long-term balance that includes around 30% gold often performs better overall than a standard 60-40 portfolio. Sometimes gold would have needed to be higher or lower, but across history, having a meaningful gold allocation consistently improves stability and results. Thompson also points out that gold's role isn't just about investing, it's tied to the financial system itself. He suggests that in the future, governments could even rethink how gold is valued to help manage rising debt. One idea he discusses is revaluing U.S. gold reserves at a much higher price, which could give the government more financial flexibility without relying as heavily on new debt. Overall, his message is simple. Gold isn't just a defensive asset. It can strengthen portfolios and may become even more important in a world of growing debt and financial pressure. Thank you for watching, and see you in the next video.